Hi, and welcome to Chapter 3, Beginning the Accounting Cycle. Okay, the accounting cycle is like the steps you go through every month in preparing your financial statements. And every company has an accounting cycle. Some may be a little different if it's more computerized versus more manual, but we're going to learn all the different steps in the accounting cycle. Okay, so learning objective 3.1, journalizing, analyzing, and recording business transactions into a journal. Okay, the accounting cycle, norm or procedure occurring over a period of time. It takes place over an accounting period. It's usually 1 year, a calendar year, January 1st to December 31st, and a fiscal year, any 12 consecutive months. But you kind of go through this process every month of recording the transactions and preparing financial statements. But on a yearly basis, you close out your journals. So we'll go through that a little more detail here in the next couple slides. An accounting period. Oh, here, I'm sorry, I forgot to kind of emphasize one point. So an accounting cycle, a year. So a calendar year is January 1st through December 31st. A fiscal year is any 12 consecutive months. My company actually owns another company, and their accounting cycle or fiscal year is October 1st through September 30th. And the reason they do that is maybe their audit, it's not as busy during that time. Sometimes you can get discounts from your auditors. There is some advantages as well if you have inventory. If you don't want to be counting all your inventory January 1st and maybe October 1st works out better for you if you have a lot of inventory. So those are just a couple of the reasons. An issue though is your tax returns are on always on a calendar year, so you still have to keep the records for the calendar year and the fiscal year for tax purposes. Okay, so an accounting period, a period of time covered by the income statement. There's interim months, monthly, quarterly, annually. So remember, on the income statement has to be for the period ended, for a month, for the quarter ended December 31st, or for the year ended December 31st. So it's for a period of time. So called a natural business year, usually the slowest time of the year. I'm not really sure what that means. Okay, we'll come back to that. Okay, what that means is a business can choose any fiscal year that is convenient. For example, some retailers might decide to end the fiscal year when inventories and business activities are at a low point, such as the Christmas seasons. This period is called the natural business year. Usually the natural business year allows the business to count its year-end inventory when it's easy to do so. So it's just determining what is the best fiscal period for you. Generally, most companies are on a calendar basis and go from January 1st through December 31st. Okay, general journal is the book of original entry. It's the simplest form of a journal. All transactions are located in the same place. Records information in chronological order. So as things happen, you go through September 1st, what happened, September 2nd, what happened, September 3rd. Information from the general journal is then transferred into the ledger. And I think once, we see pictures of this will make much more sense, but these are just going over kind of the definitions. Here is a chart of accounts for Rob Sinclair's Highlight Graphic Services. A chart of accounts is just a listing of the accounts. You have your assets, your liabilities, your owner's equity, your revenue, and your expense accounts. Assets are generally begin with a 1, liabilities a 2, owner's equity a 3, revenue a 4, and expenses are a 5. Okay, but every company has a different chart of accounts depending on what expenses they have, what kind of revenue. Everyone's is a little different, but at the same time, they are kind of the same too. I mean, somebody might have 5 cash accounts, but cash is usually starts with a 1 is the first account listed under assets. Okay, the formalities for journalizing a transaction. The debit portion of a transaction is recorded first. Now that's not mandatory, it's just highly recommended to do the debit first. The credit portion of a transaction is indented and placed below the debit portion. The explanation of the entry follows the credit. A 1-line space follows each journal to make it easier to read. And each transaction must affect at least 2 different accounts, so at least 2 different you got your double entry accounting where you're affecting 2 different accounts, and the total amount of debits must always equal the total amounts of credits. So here is an example. And now remember, a lot of these, if you have QuickBooks, you're inputting them into a computer system, and it's doing all this. You just have to put in the accounts and the amounts, and it's much easier than handwriting it here. But this little paper, this green bar paper, it's kind of hard to find. I do still have some, but most of the thing is in Excel. But this is, the accounting, the ledger paper that you use. But, again, this is a general journal, which will just list your accounts one by one throughout the month. So you have what happens on May 1st, and then go down and we'll list all the other transactions. So the first journal example is Rob Sinclair began the business by investing $10,000 cash. So we're debiting cash, $10,000, crediting Rob Sinclair capital, $10,000. Total initial investment, so this is the description of the journal entry, initial investment of cash by owner. So the description is important because, I'm doing this journal entry May 1st. I might not have auditors come in my door until February. So am I going to remember what this transaction was all about? And this is a very simple transaction, but when I worked for Blue Cross and Blue Shield, and we had journal entries that were 10 pages long. Are you going to remember what was the point of that journal entry and all the details if you don't have a nice description there? And you usually also have support attached to it, where in this case you might have a couple of copy of a check or the wire transfer, something to support this, because an auditor wants to know you're not just kind of cooking the books or something. Okay, so we increase cash, so we're debiting. Cash is an asset. We debit it to increase cash. We're also increasing capital to increase credit capital. We credit it. Okay, so remember your rules for accounting for the journal entries. Okay, on May 1st, we also purchased a computer from GG Company for $6,000, paying $1,000 and promising to pay the balance within 30 days. So this is called a compound journal entry because it has more than 2 accounts. It has multiple credits. Only the day is entered if the transaction before contained a year and the month. Okay, so only, it's May 1st, so we're only putting the 1st because, up above on our column we got May 1st. You don't have to repeat it all the way down. Okay, so we purchased a computer. Computer equipment is an asset. To increase it, we debit it. We were paying with cash and putting some on account, so it goes to accounts payable. So cash we're decreasing, so we're crediting the asset. accounts payable is a liability, and we are increasing our liability, so we credit that. Okay, your debits and your credits must be equal. Okay, May 1st, rented office space, paying $1,200 in advance for the first 3 months rent. So prepaid rent is an asset. To increase it, we debited $1,200. Cash is an asset. We are decreasing it, so we credited $1,200. Purchase supplies on account. We debit computer supplies, $600. And on account means on accounts payable. So we're increasing our liability, so we're crediting it $600. And we have our description here, purchase of computer supplies on account from Vision. On May 7th, we completed graphic design project for our client and immediately collected $3,000. So we are increasing cash $3,000, increasing our revenue, our graphic design fees account, $3,000. And remember, these all come from your chart of accounts where you had account numbers that you could use. And each one of your problems too on Pearson should have a list of chart of accounts that you have to use. Okay, on May 13th, paid office salary, $650. So we are debiting office salaries expense to increase an expense. We debited. And we are decreasing cash, an asset. So we credited $650. Okay, on to our next slide. May 18th, advertising bill from Digital Insert Company comes in, but is not paid $250. So we're debiting, we're increasing an expense, $250, and we're increasing a liability, accounts payable, $250. Bill in, but not paid from Digital Insert. Rob Sinclair wrote a check on his bank account of the business to pay his home mortgage payment. So that's a withdrawal if he's taking money out of the business to use for personal use. So we are debiting a withdrawal account, we debited to increase it. And cash, we are decreasing, which is an asset, so we credit it to decrease the cash account. Bill Merlin Company for a large graphic design project, $5,000. So we billed them so that now we have an accounts receivable, which is an asset, and we're increasing it, so we're debiting it $5,000. And graphic design fees is our revenue account. So we are increasing it, so we credit it $5,000. Paid office salaries. So this is hard. It makes it so hard because it's so small, but office salaries we are increasing. We're debiting $650, so we're increasing our expense. And we are decreasing our cash, so we credit the asset $650. Oh, it wants you to make a note that this is a new page, so the year and month are repeated. So the heading, and you're at the top of the page now. Okay, so on May 28th, paid half the amount owed for computer equipment purchased May 1st from GG Company. So accounts payable, we're reducing accounts payable because we're now paying cash to reduce the amount we owe. So we're debiting $2,500, and we are crediting cash because we're paying, we're decreasing cash, so that's a credit. You know, so when you're doing these transactions too, maybe you don't really know what should I debit, what should I credit. Try to take the easy one. So like received and paid telephone bill. Well, you know, it doesn't say on account or anything, so you paid with cash. So when you receive when you pay something, the cash is usually the easy side of the transaction. You know cash is decreasing. And you should know when you're decreasing cash, which is an asset, you're crediting it. So, figure out the one side of the entry and then go back and figure out, your expense. You have to be increasing in debit. I mean, it's best to go through the rules of accounting for each line and, make sure, but if, try to take the easy side, do the cash side first. Is it increasing or decrease? So you know if one side's debit, credit, the other side's got to be the opposite sign. Okay, and I think that concludes our journal examples. Study hard, go over these examples, and good luck on the assignments.